Hello, everybody. The topic of this section is financial market risk. When we read some reports of financial market indicators, they include interest risk, exchange risk, and indicators of stock market performance. In this section, we'll explain the meaning of these risks. Firstly, let's see the interest risk. An interest rate is a promised rate of return, and there are as many different interest rates as there are distinct kinds of borrowing and lending. For example, the interest rate that home buyers pay on the loans they take to finance their homes is called the mortgage rate, whereas the rate charged by banks on loans made to business is called the commercial loan rate. The interest rate on any type of loan or fixed income instrument depends on a number of factors, but the three most important are its unit of account, its maturity, and its default risk. The unit account is the medium in which payments are denominated. The unit of account is usually a currency such as yuan, dollars, francs, pounds, euros, and so on. The maturity of a fixed income instrument is length of time until repayment of the entire amount borrowed. The interest rate on short-term instruments can be higher, lower, or equal to the interest rate on long-term instruments. Default risk is the possibility that some portion of the interest or the principal on a fixed income instrument will not be repaid in full. The greater the default risk, the higher the interest rate the issuer must promise to investors to get them to buy it. Let's consider how each of these three factors affects interest risk in the real world. For the effect of unit of account, a fixed income instrument is risk-free only in terms of its own unit of account, and the interest rates vary depending on the unit of account. For example, suppose you are investing for 1 year and the interest rate on a 1-year Japanese government bond is 3%, and at the same time, it is 9% on a 1-year UK government bond. Because of the higher interest rate 9%, is the UK bond preferred? Of course no, because the bonds are denominated in different currencies. So we should do the comparison in the same currency. Note that the rate of return is equal to the return divided by initial investment. Suppose that the exchange rate, which is the price of one currency in terms of the other, is currently 150 yen to the pound. And in further, suppose you invest 100 pounds in a UK bond. Now, the 100 pounds worth 15,000 yen. Because the interest rate on the UK bond is 9%, you will receive 109 pounds a year from now. Your realized yen rate of return will be 109 pounds multiply future yen price of the pound minus 15,000 yen altogether divided by 15,000 yen. If the exchange rate won't change, what is the yen rate of return? So, if the exchange rate is still 150 yen to the pound, algebra arguments to this function lead to a realized yen rate of return 9% of the UK bond. However, if the exchange rate changes to 140 yen to pound, the realized yen rate of return will be 1.73%. To illustrate the effect of maturity on interest rates, the yield curve is defined. Yield curve depicts the relation between interest rates yields on fixed income instruments, where treasury and the maturity of the instruments at a given moment in time. The following figure shows the U.S. Treasury yield curve on May 26, 2006. We can see that the annualized yield on 2-year Treasury obligations was about 4.95% per year and increased with maturity to about 5.15% per year on 30-year obligations. For the effect of default risk, the higher the default risk on fixed income instruments, the higher the interest rate, holding all other features constant. The following table shows the interest rates on US dollar-denominated bonds for issuers with different degrees of default risk. US Treasury bonds have the least default risk, followed by high-quality corporation bonds. Up to now, we have discussed 3 factors which affect interest rates: unit of account, maturity, and default risk. Next, let's see the rates of return on risky assets. How to measure the rate of return on risky assets who do not carry promised rates of return. Here, we consider only one risky asset, stock. When you invest in common stocks, the return comes from 2 sources. The first source is the cash dividends paid to the stockholder by the firm that issued the stocks. The second source of return to the stockholder is any gain or loss in the market price of the stock over the period it is held. Consider both cash dividends and the change of market price. The 1-year rate of return R is defined as ending price of a share minus beginning price plus cash dividend, all divided by beginning price. The total rate of return can be present as the sum of dividend income component and the price change component. That is, the rate of return is also equal to the cash dividend over beginning price plus ending price of a share minus beginning price divided by beginning price. For example, suppose that investing in a stock costing $50. It pays a cash dividend during the year of $1, and you expect its price to be $60 at year's end. Then, the expected rate of return is equal to the expected ending price of this share, $60 minus the beginning price, $50, plus cash dividend, $1, all divided by the beginning price, $50. It's 22%. If the stock's price is actually $40 at year's end, your realized rate of return will be the ending price, $40, minus the beginning price, $50, plus the cash dividends, $1, all divided by the beginning price, $50, and be minus 18%. Finally, let's see the inflation and the real interest rates. People have long recognized that the prices of goods, services, and assets must be corrected for the effects of inflation in order to make meaningful economic comparisons over time. The following contents are defined to correct for the effects of inflation. The nominal prices are prices in terms of some currency. The real prices are prices in terms of purchasing power over goods and services. The nominal interest rate is the promised amount of money you receive per unit you lend. And the real rate of return is defined as the nominal interest rate you earn correct for the change in the purchasing power of money. The general formula relating the real rate of return to the nominal rate of interest and the rate of inflation is: the real rate is equal to nominal interest rate minus rate of inflation, altogether divided by 1 plus rate of inflation. For example, what is the real rate of return if the nominal interest rate is 8% per year and the rate of inflation as measured by the proportional change in the CPI is 5% per year. By the formal formula, the real rate is equal to 8% minus 5% divided by 1 plus 5% and is 2.857%. In summary, in this section, we have studied the interest rates and the effects of 3 factors. We also studied the risk of return on a risky asset, common stock, and how to correct for the effects of inflation. That's all about this section. Bye.